Hello and welcome to this very special episode on Moneycontrol. I'm Mahalakshmi and I have with me a very astute economist as guest today. He was the Deputy Governor of Reserve Bank of India earlier. Now he's a professor of economics at the Stern School of Business in New York, and he's an academic advisor to the Federal Reserve Bank of New York and Philadelphia. Dr. Viral Acharya, thank you so much for joining me for this discussion today. So Viral, let's just dive into the conversation straight. I mean, the first question is obviously the big beast that we have right now is inflation. And in January, US inflation was at 7.5%. Now it has come in at 7.9%. But even that is pre-war. After that, prices have gone up even more. What is your own expectation in terms of, short term, medium term? How does the inflation figure for the US look?
Most of last year, the inflation on ground has been very high and palpable in the United States. If I was to just take my own view as a consumer, pretty much all prices, furniture, restaurants, fuel, rental cars, and rental prices, house prices, asset prices, everything was on a tear at least until November of last year, when the Federal Reserve finally showed, I would say, greater and more convincing resolution to raise interest rates in March 2022. One view of this inflation is that it's essentially all supply driven, but clearly I don't think that's entirely the case. The demand stimulus in the United States has been very large, both monetary as well as fiscal. Some of it has gone into asset markets. Over time, it has also entered into consumption. Clearly, there is more consumption of durable goods than of services during the pandemic, but that's reversing now as well. And undoubtedly, the supply side constraints have played a role. The pandemic has affected the global supply chains. Pre-pandemic as well, there were several disruptions in the global supply chain because of the tariff wars. And now you have the actual war, the invasion of Ukraine by Russia, which I think means potentially problems for crude, metals, food, and there could be second order effects from all of this. One last point on this, Mahalakshmi, is that for a while, everyone thought that the long-term inflation expectations aren't budging, that it's really the short-term inflation expectations that are rising. I think this is beginning to change as well. Most recent data seem to suggest that the gap between 5-year treasuries and the treasury inflation-protected securities are suggesting now that inflation might be expected to be higher even at the longer horizons. So I think this is going to be a very tough year in terms of inflation expectations. Consumer sentiment is down. It may go down even further. At this level of oil prices and the sudden change and the expectations of 6 to 7 rate hikes of 25 basis points each over the next year, I think one has to seriously take into account the risk of a recession in the United States over the next 12 to 18 months.
What do you see as a persisting problem? Is it that because of sanctions now, which might just linger on or persist for quite some time, that you might continue to have rising prices? Or is it anything else? For example, the cost escalations because of all these policy changes on account of climate change and several other things that are happening. What is it that is going to keep prices high?
See, it's really a confluence of all of these things. If you had asked me a couple of months back in January, I would have said that it's already going to be a difficult year purely on the basis of the US factors, which is that the demand has been stimulated to be very high. The global supply chains, both because of pandemic and the tariff wars, aren't able to adjust as well. There's climate change on the horizon, which is pushing up the prices of fossil fuels, especially because renewables are not yet large enough to substitute entirely or in a significant measure for them. Now, on top of that, you have the further uncertainty on the global supply chains created by the war and the sanctions. See, the global supply chains are very sophisticated. Companies can't just nimbly switch from one set of suppliers to another overnight. They have to engage in due diligence, product quality control, figure out the logistics of and the shipping and the transportation logistics of how the goods have to move from now different parts of the world to where they are. So it's not easy for those who have surplus to move into the supply chain as quickly, nor is it easy for those who need the surplus to move in there easily as well. And it's important to note that all of this is creating a fair amount of uncertainty as well. So insurance premium might go up as a result of some of these factors. Those then also get built into the logistics and the transportation costs. So I would say all of these to me seem like persistent factors. Is US demand at relatively high levels? Yes, it is. Are the supply chain problems likely to continue? Yes, they are. Is the uncertainty about the war and the sanctions likely to get resolved very soon? Doesn't seem to be the case. Are we going to quickly revert on climate change and simply say creating more capacity on fossil fuels is the way to go? Probably not. And finally, I would say we have to factor in that households form expectations in an adaptive manner. Whether it is 40% demand, 60% supply, that's not the calculation they do. They are seeing persistent prices on food, fuel, furniture, and other goods month after month after month. They are showing us in the inflation expectation surveys, they are showing us now in prices of medium-term treasuries relative to the inflation-protected securities that household and investor inflation expectations are now getting anchored to higher levels. So I think it's a confluence of all of these factors, and it's just getting worse each month. I think it's been a really bad series of shocks, but that's the danger one always has when one leaves reining in inflation towards the end rather than dealing with the beast once it's beginning to rear up its ugly head.
Sure. So as somebody who has been at the helm at a central bank, tell me, what are the options really for the central bank? Because it seems like a bad idea to be tightening at times of supply shock, but that's pretty much the option that Fed right now is left with because it's really raging right now.
I think there is no substitute. I think the Federal Reserve governors have been very clear in their remarks over the past 3 to 4 months, especially that the economy is back, that this is not like the global financial crisis where the recovery was very tepid. Here they are saying, no, the recovery is very strong. They are happy with the jobs and the employment numbers where they would like to see them. So they are sending a message in, I would say, unequivocal terms that, we are ready to lift off. We are ready to stop the purchases, and we are ready to start sucking out the surplus liquidity. Some governors have also hinted at 50 basis points rate hikes in a go, sort of double hikes. Maybe that's more communication than rather what the first hike might turn out to be. But they are essentially saying, yes, they may have called it transitory inflation over the last year. Without using the same words, they are saying we were wrong. Now is the time to move on, and that we have to rein in inflation. We are not comfortable with the level at where it has been, and persistently so. I think there is no option on the table. They have to now bring the inflation down. Maybe the asset price corrections and the war and the sanctions and its after effects on prices may bring about a consumption contraction that is faster than what they might be expecting. Maybe that means they don't have to engage in as much tightening as they would otherwise. But I think they have to start, and I think they will start this month in a decisive.
So you do think that monetary policy will have a reasonable effect on reining in inflation? At least it will create suppression of consumption to that extent, you will be able to keep it under check?
Absolutely. In some sense, consumer sentiment is already weak right now, but the prices and the wages are sort of moving ahead in a spiraling manner because, US is a very nimble labor market. People quit jobs very quickly in order to bargain to a higher wage level very quickly. There has been a bit of concentration in corporate power that has been happening over decades. Pandemic has added to that concentration, so the capacity to push prices onto the consumer is also high at the corporate level. And so I think what really remains to be seen is how strong are the financial market channels of the tightening. Because clearly the stock market has been frothy, even though it has had a 10 to 15% correction. Many would contend that it is still at a very frothy level. There's a set of stocks within the overall market that have been the darling stocks over the last 2 years, and their valuations are perhaps not justifiable based on sort of simple fundamental analysis. One has to see how big are these corrections when the monetary stimulus, both on rates front as well as liquidity front, is finally withdrawn. And I think one point I want to stress here, which is getting ignored both for the US and the West, as well as in India to an extent, is that when monetary stimulus creates these financial asset price inflation, there is a wealth channel to consumption at work. Those who have long duration assets, those who have financial assets, they become suddenly very wealthy. And they want to spend, they want to then buy another house, they want to buy a bigger house, they want to buy a better car, they want to go to more expensive restaurants, they want to drink better wines, they want to replace their furniture and shades with the best options they have out there. A lot of the consumption, in my view, over the last 2 years has been driven by the wealth effect on the wealthy, rather than actually direct fiscal transfers necessarily at the bottom of the pyramid. Of course, in the US, there has been that as well, but not so much in emerging markets such as India. I think as the interest rates tighten and the monetary stimulus is taken, if there is a sharp correction in asset prices, there could be a sharp correction in the consumption of the wealthy as well. But I think that remains to be seen.
Federal Reserve also has left us with a feeling that they don't want to really disrupt the equity markets because this time around, especially in India, the wealth effect of the stock market rise has been phenomenal. Is that a legitimate fear that even central banks should continue to fear about, or is that something you have to learn to live with? Taleb has continuously been saying that there should be stressors in the system, but we've not had any stressors since 2008 rescue operation.
Yes. See, partly it's their own trap. I think central banks have created their own traps, I would say, the world over. I think they adopted extraordinary monetary accumulation. I think in US there has been overheating. In India, I would say the recovery has been very uneven. The consumption and the wealth effects have been very strong at the upper end, but it's very clear that jobs and real income, which is wages relative to inflation, have not been rising as well for the bottom of the pyramid. The stock market becomes a very attractive signal to wake up every day and look up to. Is the market doing well? Oh, my policy must be great if the market is doing well. And then you get caught with the froth yourself because you are captured by your past decisions. You don't want to look at the facts in an objective manner. That's how partly you might get trapped into this habit of calling any rise in inflation as transitory and supply driven rather than actually getting anchored into the economy. So I think it's partly a trap of their own creation. And sometimes when you are in a trap, you have to leave out of the trap as soon as possible rather than actually getting further entrapped into the situation. In my view, India has to focus on a more even recovery. India, in my view, has been skirting with inflation around 6%, sometimes above the band, sometimes just below the band for quite some time now, I would say 2 to 3 years. And I think we are not even at growth levels which are commensurate with our pre-pandemic growth levels. Okay, we are larger than when we were pre-pandemic, right, but we are still short of what our growth should have been if you extrapolated the pre-pandemic trends. Many would argue that our growth has actually been lower for 5 years now, not just pandemic-induced contraction, but it has been slowing down even prior to that. I think then monetary policy has to acknowledge, be modest, and recognize that perhaps the slowdown in growth is structural rather than cyclical. And it's not something that monetary policy can keep throwing liquidity and interest rate cuts at. Because if the structure of the economy requires fundamental changes for growth creation, be it disinvestments, be it reduction of tariffs, be it figuring out how to improve the ease of doing business, get more FDI into some other sectors, be it creation of service jobs, whatever that is, this requires then work by the government, and it's not something that the monetary policy can continuously do the lifting on. I think we have to seriously consider the risk that the consumption of the lower part of the lower income brackets in India is getting eroded. Wealthy can't keep consuming at higher and higher and higher rates to keep taking India's growth to higher levels. You know, ultimately, the consumption boost has to be across board. It has to be more even. And I think it would be modest, in my view, of monetary policy to recognize its limits now. And do the job it is required to do, which is to anchor our inflation at 4% CPI inflation rather than skirting at the top of the band, which is closer to 6%. Because I think it's been several years now that the growth has been below par. I think monetary policy can't just skip acknowledging that this is now a structural problem and not just a cyclical problem.
Do you think the Fed is finally ready, irrespective of whatever the consequences could be for the financial markets or equity markets? They're really now at a stage, whether it is at a stage that they will have to tighten fairly aggressively to ensure that they're able to address this problem to the extent that it is solvable through monetary policy. Has that point really come now, or you still anticipate that it will, the policymakers will still take it slow and find some way to beat around the bush and not disrupt the ecosystem in any significant way?
I think so. I hope so. That is what I'm hearing from the Fed governors, that they now mean business about inflation. They are happy with where the growth is. Without using the term overheating, I think they are effectively saying that given the levels of inflation, perhaps there is overheating and we are ready to now cool the economy down. They will have to calibrate, of course, what their policy is to evolving developments around the world. But I think the Fed has to do it because they have to retain their inflation credibility at medium and long term. They cannot allow inflation and wage spirals to become a runaway problem. This is especially important because the US government has also borrowed very massively over the last few years, especially since the pandemic. And while there is a strengthening of the dollar, there is a pouring into the US assets because of the uncertainty created by the war and the sanctions. They can't just take it as given. Ultimately, yes, dollar does have the exorbitant privilege, but there is something that has to be done every day to ensure that you continue to have that privilege. And right now that requires ensuring that the inflation credibility that was built by Paul Volcker and subsequent actions of the central bank, they are restored. I think you don't want to be at a Paul Volcker moment of double-digit inflation, because that would require really tightening in a very, very hard manner. I think that's already been engineered to an extent by being late in the inflation cycle, but you don't want to do more of that. I think they have to tighten as gracefully as possible to allow the economy to adjust in a softer way. Even if it's a recession, you have to ensure the transition is smooth rather than sort of really suffocating growth in a very short period of time.
What do you expect as the outcome of the 16th meeting, March 16th?
I think clearly a rate hike should be expected. I think it's a no-brainer now. I think the market expectations are actually saying there will be 6 to 7 rate hikes over the next 12 months of 25 basis points each. I think that is where people will be looking for more signals from the Fed, which is how much do they telegraph at this meeting, what sort of rate hikes to expect. When the minutes come out, I think analysts will be keen to watch what the expectations are of different governors in terms of their own forecasts of inflation over the next year. So I think it's more the forward guidance on what next. I think the 25 basis points rate hike is a given. I conjecture that they won't go for a 50 basis point hike right away, perhaps because of the war situation. Otherwise, even that might have been on the table.
Do you fear any significant dislocations in the financial markets or in the in that ecosystem, in the institutional framework, etc.? I was reading yesterday there was a report about PIMCO's exposure of about $1 billion to sovereign Russian sovereign debt, which now the market is discounting and saying there is a very high possibility of default. They also have credit default swaps of about $1.5 billion. That is obviously it's a very small amount for PIMCO, but overall, do you see any early signs of stress that can be caused to the larger system? Because the risk to markets always come from unknown quarters.
There are some early signs of financial fragility, I would stress, but they are not on the scale of what we saw at the time of the full onslaught of the global financial crisis or the pandemic's outbreak. They are moving in that direction. They are sharp, but they are not all the way there. Let me point out three that I think are important. The spreads in both investment grade and high yield debt have widened. In case of investment grade US corporate debt, they have actually doubled. But that's been happening steadily since November when the rate hike expectations got built in. So it's not just due to the war. What the war has caused is the heightened uncertainty. The levels of VIX have gone up to above 30% now. In fact, last week, there was no high yield debt issuance in the United States. And that's a sign that asset managers are feeling the stress. There is some uncertainty, and they are unwilling about the risks that they can take on further. And they've been pumping a lot of money into high risk debt at fairly low spreads over the last 2 years. That's one. Second, I would stress that some banks are more exposed to Russia than others. I prefer not to take names of any individual banks, but within each country, some banks have more exposure. And what bank credit default swaps are highlighting is that credit markets are beginning to discriminate between exposed and less exposed banks. Why is that important? Because that could mean that there could be some discrimination amongst banks, even in the interbank markets and wholesale finance markets at overnight and short-term maturities. And third, I would say short-term funding markets, such as 3-month commercial paper, 3-month forward interest rates relative to overnight interest rates, they are beginning to show signs of stress of the type that you see when interbank confidence has weakened somewhat. And usually uncertainty amplifies that very substantially. So we are beginning to see widening of these 3-month market funding spreads. And if commercial paper markets either ramp up the costs of funding or they get stressed or even frozen for a few days, that will mean there will be drawdowns on bank credit lines, which is that becomes like the beginning of a dash for cash, as we saw both during the global financial crisis and at a far more ferocious pace in March of 2020 when the pandemic outbreak happened. So I would say these are early signs of financial fragility, but these are usually the canaries in the coal mine that one wants to keep hearing. And when you don't hear them, it does give you a moment of pause, and then you have to be watchful. And I think that's the main message I would convey from what I have been gathering over the last 3-4 months, that lots of headwinds for global growth are coming together into what one might call as perhaps like a perfect storm. Lots of uncertainty is building up. Lots of risk are on the horizon. This is not the time, in my view, for emerging market policy to swing for the fences on growth. I think this is the time to risk manage. This is the time to embrace and be happy about the fact that we have stabilized the economy from falling off the cliff at the time of the pandemic, but some corrective measures that need to be brought in to build inflation credibility, to send the right message to the markets that we mean serious business in not letting inflation take hold. We are preparing ourselves for a possible external sector difficulty that may arise if US experiences a recession or a financial market dislocation. I think it's time to start sending some signals which are more of risk management, financial stability perspective, rather than saying we are focused all along on growth at each point of time.
Sure. What is your perspective on dollar, Viral? Because especially after this impounding of central bank reserves from Russia, there is this fear that one theory is that it might just scare other central banks into diversifying, or at least thinking about diversifying their reserve base. Do you even see that as a credible path? If at all it happens, will that money really look towards gold, or is there some possibility of recalibration based on trading partners and stuff like that? How do you see this working out, and what is the prognosis for the dollar? Because dollar traditionally is seen as a safe haven. So every time there is crisis, the world goes back to the dollar.
Of course, in some ways, that's been proved all over again. Dixie, which is a good index of dollar relative to other advanced economy currencies, has only risen over the sanctions period and this uncertainty. I would say now.
But that money, if at all there is any reprioritizing of reserves or diversifying, that money has really not come into the market. That's not played out yet. So I'm thinking more about medium term, 1 to 3 year. How do you see the trajectory? Does this get altered in any significant way?
I'm doubtful that this means bad news for the dollar in that sense. I think bad news for dollar would be if US doesn't manage its fiscal health very well, US doesn't manage its inflation very well. There's a loss of credibility on inflation or inflation expectations front. If there are signs of social discontent which are leading to bad politics in the United States, etc. I think to me those are the signs of I would say those could be signs that could lead to lack of confidence in the dollar. Like in my view, some of the moves of the past administration were of that nature and could have led to question marks about the US policy. If you are looking at this, the current developments, in a way, you would say US has ultimately taken the right stand. Okay, you may agree or disagree with whether financial sanctions should be used as a part of a war, but at least it's the right stand in that the world order was shaken up through the invasion, and the United States has ultimately taken the right stand, even though there could be consequences for its own players, corporates, financial firms, and to the economy from this. Now, of course, there are parts of the world that may or may not want to be dollarized as a result of this. To me, that would almost be sending a bad signal. If you are a central bank right now that's trying to diversify away its reserves away from dollars, are you sending a signal that your country wants to be part of this other alliance rather than actually be part of the alliance of the Western liberal democracies? I think clearly some governments may be thinking about these kinds of risks, but to me, that would actually be a bad signal to be sending to the global capital markets if you were a central bank or an economy. Now, over the long term, what are some alternatives to the dollar? I think that requires some thought. Everyone thought renminbi could maybe arise as a contender given the size of the Chinese economy. But Chinese economy is slowing. It's looking more inward geopolitically. People have question marks over what it's doing. Yeah. I think the current situation doesn't help, in my view, with that. We have to remember that just in 14 and 15, when there was a massive stock market correction in China, there were all kinds of restrictions put on capital mobility in China. That doesn't contribute to helping create a reserve currency, in my view. Correct. So I think the size of the US economy, the strength of the dollar, and the confidence that in the end the US does the right thing is probably only entrenched by the current set of sequence of events. Of course, in a broader scheme of things, it would be better to have more safe currencies, greater supply of safe assets. But it's not hard to create safe assets because that requires macroeconomic stability, institutional credibility, a large economy, and your currency being used to settle financial contracts. I think let's not forget that. Why was it possible to impose such sanctions on Russia? Because a lot of the Russian economy is also working under financial contracts which are settled with dollars. Its central bank was maintaining a large pool of dollar reserves, even though it seemed to have moved away over the last few years in maintaining all of its reserves in US dollars.
How about the gold? Is that a worthy contender?
My view is that on the one hand, inflation, as long as it's high and the uncertainty about inflation is high, it will create a room for a dollar to become attractive as a hedge against inflation. We saw that bubbly liquidity conditions post global financial crisis also led to a surge in gold to $2,000 per ounce sort of levels. As inflation is reined in, and hopefully it will be reined in soon over the next 12 to 18 months, I think that demand will wane as well. But in the short run, I think it will be of interest. It will be of interest even in economies where interest rates are still negative in spite of rising inflation, such as in India. I think Indian demand for gold is also on the rise. That adds to the current account deficit. And it's something that we have to consider as a potential risk over the next 12 to 18 months.
Current account deficit, is that the biggest risk that India faces now? And, one of the things that a lot of economists say is that India is really behind the curve in terms of raising rates. Do you see that as a risk, or is it more pragmatic to take it slow on that front so that you don't nip growth at early stages?
We are in fairly uncharted territory on the external sector front, in my view. US is going to go in a very tightening phase, as I described earlier. We have lots of uncertainty relating to the war, the sanctions, and early signs of financial fragility. And the compounding of these two only adds to the uncertainty that we already had even without the war. But even the tightening, we have not seen monetary and fiscal stimulus of this type. We have not seen what happens when monetary stimulus of this scale is withdrawn. We have not seen inflation of this levels in the United States since 70s.
Right.
So in my view, you have to try and structure the economy to be right on all fronts in order to face this kind of risk. The approach, in my view, has to be one of stress scenario. You have to stress test the economy. You have to try and look good on fiscal front. You have to try and look good on external sector front. You have to try and look good on structural reforms front. You have to try and look good on the balance of the growth engine within the economy. Domestic strength of the economy in terms of consumption has to be right. In fending off perhaps a potential reduction in the demand for exports from the rest of the global economy. Financial stability is a trade-off. I think I would stress that financial stability does require that sometimes you can't focus on growth. You have to make a growth sacrifice. That's what inflation credibility is about. You have to make a growth sacrifice. That's what fiscal stability is about. It says that, yes, you could aspire for more in the short term, but you have to look for the structure of the economy to be right in the long run so that you can fend off external sector problems.
What is your ultimate fear about India's economic growth? I mean, what is the one thing that really would worry you?
I think it is probably the job creation, I think. The numbers, the GDP numbers, the stock market, our foreign exchange reserves are what they are. but they are not lining up very well with the creation of jobs, the quality of the jobs we are creating, their adequacy relative to the needs of our demography. I think that is what worries me the most. There are some interesting options on the table, becoming a bigger part of the global trade through tariff reductions, um, maybe having more of a service-based focus for our growth, because that's where we have the human capital and the talent. Maybe we need to skill even more people to become part of the global service exports, where we have done exceedingly well over the past 3 decades. And disinvestments, I think improving the efficiency of our domestic enterprises and the use of capital. I would say we have to focus on jobs, and that is where I would be worried the most in the long run for the economy.
Thank you so much, Viral.
Thank
It was
you.
absolute pleasure talking to you. Thank you so much.
Yeah, thanks a lot.